Hi there. Welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Patrick Horan, principal at Agilith Capital, will be joining us for the hour. Then in 30 minutes, the January employment report will be released. Brendan Bernard, senior economist at Indeed, will be here to help us break down those numbers. And we want to hear from you this morning on First Call. You can call us with your questions, and we will have Patrick Horan answer as many of them as he can at the end of the show. The number to call will be 1-855-326-6266, and we will open the phone lines in about 30 minutes from now. Our email address is also firstcall@valmedia.ca. And now let's get to some of the stories we're following for you. Shares of Canopy Growth are higher in the pre-market. That's after the cannabis company posted net revenue and profit for its third quarter that topped estimates. Canopy says the results were led by strength in Canada and are due to cost reduction actions. And shares of Amazon are falling in the pre-market after the shipping giant says it plans to spend $200 billion this year on data centers, chips, and other equipment. The forecast is $50 billion higher than analysts had predicted. Analysts are noting concerns about how much big tech companies are spending on AI-related investments and when they will pay off. And shares of Stellantis are plunging in the pre-market. The automaker says it's taking a more than $25 billion write-down linked to its shift in EV strategy. The write-down covers the cost of canceling EV models and compensating suppliers. The company also says it is selling its joint venture battery manufacturing plant in Ontario to its partner, LG Energy Solution. And now to our top line story. It's been a volatile week on the markets. Fears over AI and aggressive spending have impacted the markets this week. And to better understand that volatility, we're going to bring in our guest for the hour, Patrick Horan, principal at Agilith Capital. It's good to have you join us today. Thanks so much.
Thanks for having me on.
So we saw an interesting week for sure. It looks as though maybe today potentially investors are starting to buy into the dip. What did you make of what we saw this week and what we're seeing in the pre-markets this morning?
Well, we did see some confluence of what was the setup was, a fantastic market over the past 3 years, especially for software, and with the assumption that the future looks as rosy as the past, and markets don't actually cooperate like that way. So there was a high degree of contrarianism that could end up disrupting that. And what we've seen is AI put into question the very basis of what the software models are all about, which is high moats, high barriers to entry, and very sticky customer bases. And so that is really shaking the confidence of the past thoughts and these multiples that software companies, SaaS companies have demanded have really been through the roof. Like they were it was reminiscent to me of the .com era. Of just how much momentum had been built in, how the high growth rates and the high expectations that these models would give. So, so the setup was, that hey, we've got everything's coming up roses, and it's just going to continue, and and now we have a big question mark in the basis of these business models, and we are also on the side of that skepticism, by the way, in terms of questioning the business models.
Okay, I mean, it really just goes to show too how fragile the sector is. Some of these companies are when it comes to like a big competitor coming out with a tool and the rest of the stocks kind of plunge. On that note that you just finished with, though, I mean, we're talking about aggressive spending a lot this week. We've seen some of the companies come out with some overspending. You're talking about like Amazon, Alphabet, and investors appear to be concerned about that. Is that valid?
Yeah, it's absolutely valid. The pace of adoption, I just want to make sure everyone understands this, because it's at a hyper scale that we haven't seen before. the radio took 20 years to get into everyone's homes, and television took 10 years, and the internet was 7 or 8 years, and cell phones were that much. We're talking about AI being available to everyone who has a cell phone instantly, and you've got 500 million people already using it, and it's barely a year old. So I think that adoption rate is really one of the fastest technology adoption rates that we've seen. So the possibility of change here is immense, and I think it's you have to look at this and go, okay, what is the future going to be all about? And what we know is that the AI is going to be a better search tool. Certainly, it's going to bring more customization, and it's going to be hard for the old digital economy to compete with that going forward. So yeah, absolutely. There's a big question mark in what do the software companies of the future actually stand for? How do they maintain that sticky moat?
Yeah.
Because there's cracks in it already.
I want to switch gears here just before we have to take a quick break and talk about the January labor force survey coming out today for Canada. It's coming out at 8:30. We'll be breaking those numbers on this show. But I'm wondering what you think, what you're expecting to see. Like I know some analysts were saying that they expect, the trade uncertainty to dent hiring for the month of January.
Yeah. Yeah, I think it's it's funny. Canada's kind of we joke about it's a random generator of numbers. It's very hard to get a consistent read. But our thoughts are that immigration is down, and our birth rate is we barely support our population between the immigration we have. So we're expecting low numbers over the long term. We think we've switched from high immigration to low immigration, and as a result of that, our labor force just is not going to be as strong, and we just have to mentally prepare ourselves for that. So it could be 10,000, 20,000. That would be a very optimistic number in our view.
Okay, we're going to have to wait and see at 8:30. We're going to take a quick break right now. Patrick, thanks for that. You're going to stay with us for the hour, of course. Up next, we'll take a look at the markets before the bell. Stay with us. Welcome back. Here's how things are shaping up on the markets today, beginning with the U.S. futures, all trading up at the moment. The Dow up 0.4%, the Nasdaq up 0.4%, also the S&P 500. Seems as though investors are, as we're talking about, buying on the dip after what was a pretty volatile week for particularly U.S. markets. And we'll take a look at how major Asian markets finished the day. Mixed as investors continue to assess AI and software stocks overseas. The Nikkei is the only one seeing a slight gain, up 0.8% at the close today. Moving over to Europe, we'll take a look at how things are trading there currently. Volatile Friday session today. And Novo Nordisk rebounds, setting off a sharp plunge by Stellantis, which is affecting European markets. But right now we're seeing some mixed trading. And we'll take a look at where the TSX finished the day yesterday. It was down by 1.7% after finishing up the last couple of days. If we take a look at some of the biggest winners and losers on the TSX composite yesterday from a percentage standpoint, Celestica was the biggest winner, up 6.4%. Superior Plus up more than 3%. Vizsla Silver down more than 12%, and Bitfarms was the biggest lagger of the day yesterday, down just over 16%. And we'll take a look at how precious metals are performing at the moment, the price of them. Gold advancing after an earlier retreat. Silver, though, has been whiplashing this morning. Right now, it's down by 1.5%. Copper also appears to be fluctuating as we're looking at it, but not much movement in the copper front. And we'll take a look at crude oil. Oil prices wavering as well as traders await the outcome of a U.S.-Iran talks that's happening in Oman, and that's really been pressuring oil prices over the last couple of days. And now let's turn our attention away from the big companies to the smaller caps and indices with our guest host this hour, Patrick Horan, principal at Agilith Capital. Patrick, you like small indices, so let's talk a little bit more about that. Do you think this is the year where small caps could really see some significant gains?
Yeah, I do. The idea of small caps have been out of favor for, I would say, probably the better part of the past decade. It's been larger cap stocks that have gotten larger. They've been able to scale. They've been able to use their efficiencies and actually spread their very business models around the world and really capture an aggregate global economy for themselves. And the small caps have been, especially value small cap, have been really left behind. And we think, that digital world, the virtual world of the business models, are now finding their way back to the actual to the physical world where they actually have to build things in order to get things done. So, in other words, hyperscaler technology stocks, the FANGs or whatever, all going into AI through data centers and having to spend more and more. And so that is they used to be fantastic free cash flow companies. But now they've got to use that free cash flow and put it back into the real world through hardware and through wires and all kinds of other stuff. And we think that is spawning on a new way of thinking of these small caps that have been left behind, especially on the value side, the industrials, the companies who actually physically make stuff and supply stuff, because now they have tremendous amounts of leverage. Especially if they're selling into data centers, but even the peripherals, even getting power to the grid, getting the reshoring of from a geopolitical standpoint all over the world, bringing back defense and spending properly on defense and having more of a nationalistic attitude with respect to your government spend. All of these things are creating a fantastic opportunity for small caps to actually take advantage of. And I might add, and we're doing this, I have to believe every entrepreneur out there is doing it. We're looking at AI and we're going, how do we change our business model? How do we duplicate the things that we couldn't do before? And how do we get better? And we took a concept 3 days ago that would probably take us, I would say, a month to do with lawyers and accountants, and we got it done in 2 days using AI. It was a healthcare plan for the the very small company that we have, implemented and perfectly executed with a partner. And it was like it was phenomenal how quickly that came together.
Interesting.
And how we could update all of our documents. So we can move really, really fast. We don't have the lumbering people, the obstacles. So this is what you're seeing with small cap companies.
So going back
this is the potential.
Going back to the different sectors when it comes to small cap, I was going to ask you which sectors you think are performing the best. I believe you said industrials. Is that the same on the TSX small cap index as it is on the Russell 2000?
Yeah. Well, the Russell 2000 is made up of growth and value, and so it's there's a mixed bag there with the Russell. We don't. So the growth side is a lot of software stocks, some hardware stocks that are in there. We would try to ignore that and push that other way. They have performed decently, but we really believe that it's really the call it the old economy stocks. The industrials, the ones that sell tools, the ones that that are in that are taking commodities and adding some value onto it and then selling it. So chemicals or gas compression, or there's a ton of them out there. They're great free cash flow stories. They haven't had a lot of growth come their way. And now they're seeing growth and they're seeing leverage, and they're getting these tools that are going to add to their productivity. So we can see the small cap revival go on for years and years, especially when you look at the logjam of these former free cash flow companies, these massive, large cap, multi-large cap companies, and what's happening with them, where they're in a race to spend as much as they can because it's so important that they reach the brass ring first. They are in kind of a death match right now because they know their business models are at risk if they don't actually reach that brass ring. And there's going to be one or two of them that actually get there. But the race is on. You can just see, we saw, Google increased their CapEx by about 40%. We saw Amazon do it. We saw Facebook do it. It's phenomenal how much they're just basically throwing out the playbook that they had 3 months ago and going, okay, all systems go. We got to hammer this down. So there's massive uncertainty on where there's an really expensive multiple, and then there's really cheap multiples where companies are growing really fast.
Okay.
And you just look at those two equations and go, okay, I know where I want to be. I want to be where there's certainty. I want to be where there's value. I want to be where there's free cash flow. I don't want to be over here because I don't know who the winner is going to be.
Okay, we got to take a quick break. We'll be back with Patrick Horan, principal at Agilith Capital, to see why Cineplex is on his radar right after this. Okay, it's time now for On the Radar. We are back with Patrick Horan, principal at Agilith Capital, to tell us why Cineplex is on your radar. Patrick, you say this company's taken on a little too much debt. You think that's a good thing?
Well, it used to
For
be a good
investors.
thing as interest rates were coming down and debt got cheaper. But we've hit an inflection point a few years ago, and debt is getting more expensive, and the carry of debt. So this company trades at about 7.5 times EBITDA, and a lot of that EBITDA is claimed by debt. It's got leverage rates of over 5 times, which is quite high, and they have an issue at the box office where they're just not producing the CGI-based films anymore. And you've got a generational move from one cohort to another that is just watching different kinds of shows, and there's no really impetus anymore to go to the theater and actually watch. So we're short the stock. We think they're going to have a very difficult time paying back all of this debt. We think that the box office has a lot of issues with Netflix, and the studios are challenged right now in terms of producing really big budget films. So we don't we're short Cineplex, and we would avoid the stock. In fact, we think it's going to go down. We think it could potentially even go into bankruptcy if they don't really hunker down and actually restructure. So we think that's coming. It's probably going to be ugly, and they're going to have to do something about that big debt load.
Okay, next on your radar is a stock where you think increased defense spending will help with this one. Tell us more about Magellan.
Yeah, Magellan, we like Magellan. I've mentioned Magellan probably 3 or 4 times over the past couple of years, and it has been a fantastic performer. I mention it now because there's a nice check back in the stock with this recent move in the markets down. And Magellan, it's not for the faint of heart, but the business model is actually pretty good. they have visibility from they're in defense, they're in the aerospace market. So their visibility between Boeing and Airbus goes out 5 to 7 years. So they have visibility there. Defense contractors, they've got very large contracts with a number of defense contractors that go out multi-years past that. So the visibility is excellent. Their margins have just been climbing back from very poor COVID challenge days of supply constraints and labor constraints, and they are one of the champions of in Canada of our defense industry. And we all know that we're going to have to spend more in Canada, and hopefully it's going to come from Canadian-based companies. I think that's what our government wants to do. So we think Magellan's a big benefactor of that. So between visibility, not a demanding stock, check back, we think it's a buy here.
And lastly, on your radar is Canadian software as a whole. Like, you think Canadian software is potentially likely to fall?
Yes. Yeah. This has been, this has been a wonderful performer over the past decade. We were actually long many of these stocks, going back 10, 15 years ago. We haven't been long. We've ignored them. But even better, we're actually short the sector. There's probably 6 Canadian software stocks that we're short right now. And we think that there's a big question in terms of their business model. What do they stand for? They have had massive margins in terms of what they get. They've been able to build upon it, and this is a typical cycle where you get companies that really outgrow and take advantage of their leverage. And then they're susceptible to a change in technology where someone from nowhere that is really hungry and is a disruptor comes and starts to eat their margin. And AI is that thing that's happening right now to software. So I would stay away from all software. I don't think this is just today, this week, this month. I think it's a year from now, 2 years from now. I lived through the .com. I saw how it behaves. It's probably 5 years before these guys figure out their new business model, and everyone's going to point to the old business model and how it's growing, but the revenue growth is going to stop. The margins are going to start to compress. The free cash flow is not going to be there, and then they've got to diversify and figure it out. So I think there's a massive consolidation period that will happen over the next 5 years. It's not going to be leadership anymore. So anyway, stay away from software, especially Canadian software included, and that's where we are short.
It's very interesting, particularly after what we saw this week as well. Okay, we're going to take another quick break right now. Patrick's staying with us, and we're breaking numbers on Statistics Canada's labor force survey for January coming up next. And our phone lines will open soon for our first call segment. You can call us here, 1-855-326-6266, or you can send us an email, firstcall@bellmedia.ca. We'll be right back. Shares of Stellantis are plunging in the pre-market today. The automaker says it is taking a more than $25 billion write-down linked to its shift in EV strategy. Stellantis is also selling its stake in a battery manufacturing plant in Ontario to LG Energy Solutions. The plant was established in 2022, and under the terms, LG will hold full ownership of the facility. Stellantis will continue to source battery products from Nexstar Energy. Shares of Canopy Growth are higher in the pre-market. That's after the cannabis company posted net revenue and profit for its third quarter that topped estimates. Canopy says the results were led by strength in Canada and are due to cost reduction actions. And shares of Reddit are up in the pre-market after the company posted fourth quarter revenue that beat estimates. The social media company says daily active users increased by almost 20% year over year, and it saw net income rise by nearly 255% compared to the year before. Following the results, Reddit plans to buy back $1 billion worth of shares. We'll take a quick look at the markets this morning. The U.S. futures all trading up. It appears investors are buying on the dip after what was a pretty volatile week for the markets. And Statistics Canada just released results of its January labor force survey, and we're getting those results in now. So joining us now to talk about that, here we've got these results in. Unemployment rate is 6.5%, so that's actually lower than what the estimate was, which was 6.8%. So joining us now to talk about this data is Brendan Bernard, senior economist at Indeed. And of course, Patrick's still with us as well to jump into this conversation. Brendan, it's good to have you. I'm wondering, like, these numbers are just coming out now. 6.5% is the actual number. Estimated was 6.8. So it's down a bit from what economists were kind of expecting. What's your take on that?
So 6.5% unemployment rate, but the number of people working fell by 25,000 in the month. So the unemployment rate, it reflects both the number of people working, but also whether people who aren't working are searching. So when you get strange months like this, where the number of people working fell, but the unemployment rate falls, that's reflecting labor force participation among people who aren't working. So it highlights how the number of people searching for work who are already out of work fell. So not a positive decline in the unemployment rate, though 6.5% as kind of a key benchmark looks decent. It's the first headline we're seeing from this report. Not exactly great. Now, just looking at some more of the details in these numbers, seeing that this was a full-time report, as in it was full-time jobs leading the way, part-time jobs slipping. These numbers have been quite volatile the past few months, but some interesting shift there. And then another metric that I've been tracking, where actually along with that full-time, part-time mix, things were a bit more positive, was on the hours worked side. So in Q4, the Canadian job market fared surprisingly well, but the number of hours people were working just in the total economy were quite flat, fitting with some of the other weak economic data points out there. We see, though, in the January numbers that hours worked rose, kind of fitting with like I said, the full-time, part-time mix. So some strange stats in today's report, but that drop in the unemployment rate, good news on its face, but actually some of the details a bit weaker underneath the surface.
Yeah, and manufacturing jobs, like I'm just seeing a note here on Bloomberg saying manufacturing jobs have dropped by 51,000 since January of 2025. So in the last year, there was a lot of expectation that potentially the uncertainty with the economy, tariffs, the ongoing trade war would, damper any hiring that businesses were planning on doing. I'm assuming that's some of the factors here, right, in the numbers we're seeing today.
In the manufacturing sector, definitely. The numbers since early last year have been pretty weak, and the LFS data have been kind of. It hasn't been a straight ride down in the LFS data, but we've got other data from StatCan that this report fits in with, that just the trend that this sector is really under pressure, which isn't a surprise. It's highly integrated with the U.S. economy, and you have both direct effects from the products that are under tariffs these days, hitting jobs, auto parts manufacturing, one of the areas really impacted, because those are the key parts of the supply chain that Canada feeds into. But then there's just a sense of uncertainty in the manufacturing sector more broadly, where does Canada's place in the kind of North American manufacturing system stand? The numbers today we see are weak, and we're going to need some clarity on this front for a bounce back.
Brendan, I'm curious what you think. With this is the second month now where we've seen a massive shift from part-time to full-time. And, I look at it and go, wow, what's happening here? Do you think there's a scarcity factor with some of the employers where they're just going, okay, we're gonna take these people, bring them on, and then we're good? Because that's what it kind of feels like right now. But and to your point, manufacturing is way down. So how do you square that circle?
So I hate to say it, but I think often this full-time, part-time numbers is just noise. In Q4, when the job numbers are coming out quite strong, it was part-time jobs leading several of those gains, and we saw the share of the workforce in part-time employment jump up. And now, over the past 2 months, that jump has reversed. So, I think at the end of the day, the trend is probably flat in terms of just the split between full-time and part-time jobs, because really, like month to month, the overall headline LFS is quite volatile, and just as we drill into the subcomponents, it's just they move around so much. Right now, about 18% of workers are considered part-time. That means their usual hours are less than 30 per week. It's been right around this share for the past 2 years. Some months it's closer to 18.5%. Today, the numbers came out back to 18, but it moves around so much month to month that I don't read too much into the trend.
So then I wonder to you, like, if you say part-time, full-time, that's a bit of noise and you don't read much into that. I'm curious what you do read into, because one thing, and you mentioned this off the top, Brendan, was that less people were looking for work in the month of January. Like the number of people looking dropped by 0.4%. Is that something that you would actually read into? Because that seemed interesting to me, why less people would be looking for work.
Yeah, it is interesting, and it's not exactly clear, what drove that. I think one of the stats that gets into sort of looks past just the mix of who's searching for work, who's not, and also looks past how the population is evolving. So the break-even rate of job growth has declined, which meaning like the rate that employment needs to increase for the labor market to remain stable. It's declined because the population is no longer growing quickly. And so one rate that sort of drills underneath the surface of that is just the employment rate, the number of people working divided by size of the population. And that number edged down slightly in January, but overall was pretty stable. And that's just getting a sense of like how many people are working as a share of the population, without taking too much of a look at who's searching or not, because sometimes that changes month to month. But I think the trend in the employment rate is something that looks through that, and overall it's been pretty steady over the past year or so, especially if we look at measures like the core age employment rate. That's the share of 25 to 54-year-olds with a job. And so I think this highlights how the Canadian labor market is in a bit of a holding pattern right now, where the underlying spark in the economy isn't particularly strong, but employers are holding on to workers, and conditions haven't been great for job seekers. Hiring has been pretty slow, but job stability, job security has also remained relatively strong. And it's just kind of like been a general feature of the labor market over the past few years, that the stable employment rate numbers we've been seeing lately, I think, suggest are continuing.
Okay, that is all the time we have. Brendan, really appreciate your time. Thanks so much for joining us and breaking those numbers down.
Thanks for having me.
That was Brendan Bernard, senior economist at Indeed. And of course, Patrick still joining us for the hour. Still ahead, Prime Minister Mark Carney announced a new auto strategy, and CTV's Rachel Aiello has more after the break. Plus, our phone lines are open now, and Patrick Horan, principal at Agilith Capital, is taking your questions today. You can call us at 1-855-326-6266, or you can email firstcall@bellmedia.ca. Prime Minister Mark Carney announced a new auto strategy that scraps the EV mandate while reviving electric vehicle rebates. CTV's Rachel Aiello has more in this report.
The government rolled out a new roadmap for the auto sector today. a multi-billion-dollar strategy to protect jobs and reward companies making vehicles in Canada, driven by a desire to decelerate Canada's reliance on the U.S. and on gas-powered vehicles.
To remain competitive and to realize our potential, we must develop the entire value chain for next-generation vehicles.
To help Canadians afford them, starting February 16th, consumers who purchase electric vehicles will be eligible for a new rebate of up to $5,000 for fully electric vehicles and up to $2,500 for plug-in hybrid models. There will be no price cap on Canadian-made cars, and only models coming from countries Canada has a free trade deal with will qualify if they cost less than $50,000. That means the rebate won't apply to Chinese EVs.
Helping our auto sector meet demand and compete.
Carney is also replacing the climate-minded but contentious EV sales mandate with new emission standards for future models, easing some of the pressure automakers are under.
This puts us on a path to greater electrification while giving industry the flexibility it needs during a very difficult time.
Hopefully we can get to a point where we continue to be tariff-free.
The strategy also includes investment incentives, and car dealers say they're ready to stock their lots.
It's certainly encouraging that we'll be able to pass on some savings directly to the consumer.
Beyond affordability, this country's lacking EV infrastructure remains a barrier to Canadians pulling the plug on gas-powered vehicles. And so today, Carney also promised $1.5 billion to build up this country's roadside charging network. Rachel Aiello, CTV News, Ottawa.
An Ontario woman wanted to make some extra money by doing private lending, so she took out a line of credit on her house. It was going well as she was getting interest payments each month. However, those have now stopped, and she's worried her $150,000 may be gone. CTV's Pat Foran has more in this report.
It was a relief. It was financial freedom, I thought.
Deanna Johnson of Whitby is a single parent with 3 boys. She has a full-time job and works part-time to pay the bills. That's why she was interested when she heard she could earn income providing loans.
I found out about private lending through social media, Instagram Reels, how to get like a second income to work for you.
Johnson went to her bank and took out a line of credit for $150,000. She found a company to loan out the funds and says the first year went great. She received interest payments of $3,000 each month.
It was a financial relief, some wiggle room.
But Johnson says last year the payments started to be late and then they stopped completely. In June, she asked for her funds to be returned. She's been trying to get her money back for the past 7 months without success.
I would like my money back, my $150,000.
Johnson gave the funds to Deneen Griffith of Unifocus Investments. When CTV News contacted Griffith, she said, "We are currently conducting a full internal review with the third-party company involved. Our priority is protecting our clients and ensuring all appropriate steps are taken."
Just like anything in the world, the higher the interest rate you're being offered, the bigger the risk.
Mark Ting is a financial expert who says people who need private loans have usually been turned down by banks and other traditional lenders. He says that makes it risky, and anyone considering private lending should be extremely cautious.
I would not be comfortable doing that myself, and I probably wouldn't be recommending anybody doing that unless they're extremely wealthy on their own and they could afford to lose that $150,000.
Johnson says she is now stressed and frustrated and worries the $150,000 she lent out could be gone for good.
I feel like I'm back to square one where I started, and it's really will impact my family.
Pat Foran, CTV News.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations that are moving the markets in retail. That's next. Okay, let's take a look at some of the notable analyst calls and recommendations. We'll start with Kering. Shares of that company have fallen as much as 5.1% to their lowest since September 15th after Morgan Stanley trimmed its price target on the French luxury group ahead of next week's earnings. Currently in the pre-market sitting just above 3%, down rather 3%. Analyst Edward Oben says poor performance for key brand Gucci weighed on the stock. Still, they reiterated the overweight rating as the stock is trading at an attractive valuation, setting a price target at €315, down from €370. And shares of Canada Goose sank the most in 3 years after the company missed expectations. Barclays analyst Adrian Yee cut the recommendation on Canada Goose to underweight from equal weight, setting the firm's price target at $13.69. Baird analyst Jonathan Comp cut the recommendation to neutral from outperform. Baird set the price target at $16, implying a 9.9% increase from the last price. Okay, when we come back, Patrick Horan, principal at Agilith Capital, is going to take your questions on First Call. That's coming up right after the break. Okay, time now for our First Call segment with Patrick Horan, who's joining us virtually today. And we're going to get started going right to the phone lines. We've got a caller from Thornhill. Neil? Hi, Neil. What's your question?
Good morning, and thank you for taking my call. It's been a hard week for private asset managers in the United States. And given your comments on AI and software, how do you feel about Blue Owl Capital? It came out with a report. It's showing that it'll pay a 7% dividend for the rest of 2026. I'll hang up and listen to your response. Thank you very much.
Okay, thanks, Neil.
Yeah, I would say if you don't own the stock, I wouldn't look at it. The rug is being pulled out from both private equity and private debt. They've accumulated these business models over the past 10, 5, 7 years with the idea of IPOing them. But AI has definitely changed a lot in terms of what the business models represent. So the most important thing with a company like Blue Owl is liquidity events, IPOs, mergers, getting cash back to the investor base, and they're stuck right now. My fear with this whole group is that you could be stranded with these guys as an investor, and that's not very good for the ultimate shareholder. I don't think they're going to be performers going forward. I think it's going to take years to restructure what they have in their books, and I would move on to something else. I wouldn't value buy the stock.
All right, good to know. We're going to move on now. Bill is calling in from Bowmanville with a question. Hi, Bill. What's your question?
Thank you for taking my call. I'd like Patrick's view of Descartes over the next 5 years. Thank you.
Over the next 5 years. Okay, Patrick, what do you think about Descartes?
First of all, I applaud you for thinking over 5 years, because that's the right way to think of it. This is a company that we owned about 15 years ago. We haven't owned it over the past, say, 10 years. Watched it go up and up. They had a fantastic story. Your typical aggregator of information and documentation for anything to do with logistics and transport, and they have done a wonderful job. But again, the problem here is AI really throws into question how sticky their customer base is going to be. When customers can do things for themselves, fill out documents, take complex things, and actually solve their own solutions instead of going to a software vendor like Descartes, it really puts into question their business model. So I would stay away from this company. In fact, full disclosure, we are short this company, have been short over the past couple of months, and we think it's been a good performer for us from a short side. We think it's going to continue to perform probably for the next couple of years.
Why do you say 5 years is a good way to look at it? Like, is that just in general, that's a good way to look at what you're investing into, or this stock in particular?
I think there's way too much speculation in the market. And if you have a 5-year outlook for equities, I think that's about the right time frame. We change our book probably every 5 years is probably 100% change. The average portfolio manager, the professional portfolio manager, changes it every year. So we think that's way too fast. They're chasing performance, they're chasing volatility, and ultimately there's slippage in terms of returns. So long term is always the best way to do it.
Got it.
I think that's where the contrarian mindset works the best as well. patience and value go together, and it takes years sometimes for that value to surface.
Okay, we've got time, I think, for one last question. We're going to go to an email from Spencer, and it reads, I'm wondering if today's guest has a favorable long-term outlook on MDA Space and whether they would consider it a buy at current price levels. Patrick, what do you think about MDA Space?
Yeah, I think, MDA Space is an interesting section right now. So you've got got this whole idea of putting data centers out in space. You've got a whole way of thinking new about space, and MDA is also will be a defense contractor for Canada. So you've got these two very powerful thrusts behind it. Personally, I'd like to see it come down to the low 20s. And I don't know if you're going to get there, but that's where I think the sweet spot is of picking it up. If I held it in my portfolio, I would be patient with it, though. So it's not a buy for me yet. A little bit further down. I know some of the people. We were a big investor on their IPO when it happened like 30 years ago. Anyway, we know the company well. They've got some great technology, and they're going to be part of the Canadian defense contractor side, and they're going to get future contracts. So we do like the business model. We think there's lots of growth there, but if the valuation came down a little bit further, we'd get more comfortable with the buy.
Okay, so be patient, you say. All right, that's it for us here on The Street today. Thank you to Patrick Horan, principal at Agilith Capital, for joining us today. Patrick, it was great to have you.
Thanks for having me on.
Thanks so much. Okay, Andy Bell is up next with the Open. Trading day gets underway in just over 30 minutes from now, so definitely stay tuned. Thanks for watching.